If someone promises you a top mutual fund to invest in, then let me tell you there aren't any. What remains top is asset allocation using different mutual funds and creating a mutual fund portfolio. And that's exactly what we are going to talk about today. The concept of a 3-fund portfolio is extremely popular in the US. The idea is to gain exposure to a wide array of stocks and assets in as few funds as possible. I find this concept extremely fascinating for its simplicity. I know many people struggle to get started with mutual funds. Understandably so, since there are nearly 50 mutual fund companies with several thousands of mutual fund schemes. And it can get daunting to run through this list and figure out how to set up a mutual fund portfolio. And the undesired side effect of this is that many newbie investors get scared and stay away from markets. And when you stay away from markets, you lose out on time, which hopefully by now you understand is very undesirable. So I thought, why not modify the 3-fund portfolio to suit the Indian context and help you get started. Hi, this is Karthik Rangappa, and in this video, I'll talk to you about a 4-fund portfolio setup. I think the 4-fund portfolio will be particularly helpful for people who are starting out. I'm also making an assumption that you've got your insurance in place and you're now at a point where you want to get started on mutual fund investing, but you don't know how. The purpose of this 4-fund setup is to help you kickstart your investment journey as soon as possible by removing all sorts of confusion. Of course, you can ignore this if you already have a plan in place. Typically, a mutual fund portfolio should have an associated financial goal with it. Most people struggle to identify a financial goal in the first place, and they end up thinking that they have none. Well, if not for any financial goal, retirement is certainly one financial goal that is common to all of us. So don't be under the impression that you don't have any financial goal unless you come from an ultra-rich family. So the 4-fund portfolio that I'm about to suggest is for someone who cares about retirement, saving, and long-term wealth creation. Let me get straight to the point. The 4-fund portfolio consists of the following funds: an index fund tracking Nifty 50, an index fund tracking the mid-cap stocks, a bond fund, it could be a short-term, medium-term or a bank or PSU debt fund, and a gold fund or a gold ETF. That's it, as simple as that. If you were expecting this to be a complicated setup, then I'm afraid it won't be, because it need not be. If you're expecting me to give you specific fund names, then I'm afraid I won't be doing that. In the rest of the video, I'll explain why I'm suggesting these funds and the purpose it serves in the portfolio. The first fund is a Nifty 50 fund, which is an equity fund with no active stock picking by a fund manager. Here, the fund manager buys stocks that constitute the Nifty 50 index. Because there is no active stock picking, that also means that there is no associated research with it, which means the costs associated with an index funds are usually very low. But at this low cost, you also get exposure to some of the largest listed companies in India. The second fund is also an equity fund, but this one tracks the mid-cap index. The purpose of this fund is to give you exposure to some of the biggest mid-cap stocks in the country. In terms of market capitalization, mid-cap stocks have lesser market capitalization compared to large-cap stocks. But the idea is that when these mid-cap stocks transition into a large-cap stock, the price of these stocks appreciate and therefore the value of your investments through these funds. And with these two funds, you have all the equity exposure that you need and you don't really need anything else. The idea is that these two funds together help you create long-term wealth. As simple as that. The third fund is a bond fund. The idea is to have some exposure to debt. The purpose of the third fund is somewhat similar. There are few options that you can choose. As a proxy for debt, for this you can choose a short duration fund, a medium duration fund, or even a bank and PSU fund. However, most people think that bond funds are not risky. Don't be under this assumption. Bond funds can also be risky. They have market risk, credit risk, and interest rate risk associated with the fund. But that said, bond funds tend to be less volatile compared to equity funds. The fourth fund is a gold fund or a gold ETF. The idea is to have some exposure to the yellow metal. Gold has a lower correlation with equity, so it adds to the diversification of the portfolio that we are constructing. With these 4 funds, you've diversified across equity, debt, and gold. Within equity, you've diversified across large cap and mid cap stocks. So this takes care of asset allocation in the portfolio. The most obvious question you will have at this point is, which are the funds that I need to buy? Well, as I said at the start of this video, I won't be able to help you with that. But that said, let me share some pointers so that you can keep these in mind while choosing your funds. The Nifty 50 and the mid-cap funds can also be ETFs. When selecting these funds, ensure you pay attention to the expense ratio. Remember, these are index funds and they should have minimal expense ratio. Pay attention to tracking error of these funds. When you're picking a bond fund, please pay attention to the composition of the portfolio. Ensure there is no concentration risk and ensure the fund manager is holding quality bond papers. Do check our video on how to select a bond mutual fund. Gold fund or ETF, again make sure the total expense ratio or the TER is as low as possible along with the tracking error. With these things taken care of, the next thing to worry about is to figure out in what proportion will you invest across these funds. Well, I'm assuming you're young and willing to take on risk. Therefore, I would suggest you skew your portfolio and make it equity heavy. You can look at investing 60 to 70% of your corpus in the first two funds, that's the Nifty 50 and the mid-cap index fund. At least 20% in the bond fund and the balance in the gold fund. Now, this is not a hard and fast rule. This is what I think is good enough, but your personal circumstances could be different. So tweak this based on your personal situation. Also, one of the best ways to invest and grow this portfolio is through systematic investment plans regularly on a monthly basis. Do let me know what you think about this. If you have an alternate suggestion, then please do drop a comment. Maybe the community can benefit from your insights. Happy investing.